Happy Monday, everybody. Today is December 11th, 2023, and this is your Monday Market Update. I hope you had a good weekend. It was another busy week last week, so let's jump in, recap last week, preview this coming week. This is going to be actually a huge week before things get a little bit more quiet, so let's jump in and see what happened. Monday had the week start with some consolidation that seems to have been asked for. Stocks gapped down as yields came up off their lows, headwind on stocks, add in some geopolitical issue with the missile attacks in the Red Sea, threatening to spread things, but they are still contained. As I mentioned last week, as more information is around, we thirst for more. So Swiss CPI came in below estimates. So that supports the immaculate disinflation story versus the German exports that were down, worrying about Eurozone recession. U.S. eco data did nothing to bring in buyers, so there was more sideways action as the market set up for a week full of labor data points. More 2024 forecasts are coming out every day. Latest from JP Morgan was bearish. Barclays is forecasting 4 rate cuts in 2024. ING is looking for 6. Recall, the Fed is talking about 0. By the end of the day, the Dow was down slightly, S&P down about 0.5%, the Nasdaq was down over 0.75%. Stocks did gap lower on Tuesday as Moody's got back in the news, this time with a downgrade of Chinese debt. I'm uncertain how these Moody's office in China is working out these days. Actually, I did see that they told their Chinese people to stay home the day that they had that out. That was too much for the markets to ignore. Even in the face of good eco data from Asia and the Eurozone, markets turned positive in the later morning as the JOLTS report came out and the headline and the details were good, supporting the soft landing idea. 10-year Treasury yields spent some time at 5% just a few weeks ago, hit 4.2%. That supported tech stocks moving up. The market stalled out and resumed the digestion phase of the November moves. ISM service PMI came out, and again, more U.S. eco data supporting the talking points, soft landing, prices increasing slowly, and more fading demand, but not a collapse of growth. Again, price increases slowing down does not mean prices are falling, and that's still a problem. With Treasuries back running the wind in direction. Remember, auctions have moved markets, so we'll watch those. But note, $600 billion in treasuries coming to the market this month, another $860 billion first quarter of 2024. Worry, China, Japan, and the Fed have all been the go-to buyers in recent years, and they're all currently net sellers. The tailwind as rates stay low, headwinds if they rise, and remember, if supply exceeds demand too much, rates are more likely to rise. This is not Fed action. This is the bond market doing the job for the Fed. By the end of the day, on Tuesday, Dow was down 0.25%, S&P down just a bit, and Nasdaq eked out a gain of 1/3%. Bad eco news was good for the markets on Wednesday. ADP numbers were lower than expected. Unit labor costs also lower than expected. More evidence of disinflation. Markets focused on that initially. Then cautious comments came from execs at Citi, Walmart, and Bridgewater warning about slowing demand and that the soft data may be too soft. Big jobs reports due out later in the week, so selling came in and markets closed near the lows of the day. 3 down stock days in a row. Make a note, the Dow was down just under 0.25%, the S&P down just under 0.5%, and the Nasdaq down over 0.5%. 10-year yield down almost 20% from its 5% level, still falling down to 4.10%. This is more of the markets betting on rate cuts, and I'll remind you, in my opinion, the only way we get the kind of cuts that they're talking about will be if the economy falls off the growth cliff. This is not the base case I'm looking at, and it is not my opinion. Oil is also breaking through levels not seen in a while, below 70, At least the price of the pump is lower. So big news from Techland, AMD and the new MI3000, that the AI chip, a lot of talk about competing with NVIDIA, but NVIDIA bulls say they're not there yet. AMD says otherwise. On Thursday, stocks gapped higher, looking for the first gain of the week. Jobs week did not disappoint out of the gate with jobless claims and, more importantly, continuing jobless claims coming in at multi-year highs. This, of course, is signaling what might just be what the Fed is looking for, a cooling of the labor markets. Like the markets needed it, but this eased the worries that the Fed had a rate hike up their sleeve. I'm not sure who really thought that at this point, but that did bring in some buyers. Disinflation support came in the form of used car price index falling again, and as the day went on, you got some of this anything AI support with some news from AMD and Google. So big cap tech outperformed. And as I've told you, with such an overweight in the S&P, where they go, the market usually follows, at least in the short term. Bank of Japan news was overruled by oil at 70, and the market markets finished just off the highs of the day. Dow up less than 0.25%, S&P up over 0.75%, and the Nasdaq up 1 1/3%. At the open on Friday, stocks looked like they wanted to regain the lost direction from early in the week. The highly anticipated jobs report was a bit higher than expected, and the unemployment rate was down to 3.7%. Bond yields spiked initially, and stocks opened lower. Hotter labor markets pushed the rate cut plan down. And brings higher for longer back into the conversation. By 10 a.m. Eastern, University of Michigan survey about the consumer sentiments shows the number moving up, best since July. Also, one-year inflation expectations dropping from 4.5% last month to 3.1% this month. 5-year expectations went from 3.2% to 2.8%. That had some buyers move back into the market. The deeper dive into the jobs data shows that the fear of a growth recession may not be coming just yet. That puts stocks back in the buy list for the day. The Dow was up 1/3%, S&P up almost 0.5%, and the Nasdaq up almost 0.5%. S&P close was the highest of the year, still holding below the intraday high of 4609, but the highest level since March of last year. Dow and Nasdaq also at closing highs for the year. For the week, the Dow was up just 0.1%, S&P up almost 0.25%, and the Nasdaq was up 2/3%. As I mentioned, this week will be the last big week of data, and out with a bang we will go. Today is important, but quiet in comparison. We'll get the New York Fed inflation expectations. That has moved markets lately. But then the real news begins. We'll get CPI on Tuesday, PPI, and a Fed announcement and press conference on Wednesday. Sprinkle in some small business optimism news, and this is actually important. It is one of the few forward-looking surveys we'll get this week. Thursday, we'll add retail sales and more jobs numbers. And then Friday, we'll round out the service and manufacturing eco data. Again, what is really happening in our economy. We will get a bit more of the AI news train. Oracle earnings today, Adobe later in the week. And Thursday, we'll even bring Intel to the AI party. As we bring the news cycle to an end for the year, we have one more Monday market update. Then post-Christmas, we'll have a Tuesday update to round out the year. Then into 2024 we go. I'll take this opportunity to remind you, as much as these Monday reports are all about the details, it is my opinion that the key to your long-term success is getting a plan, putting it to work, monitoring that plan for need to change it when necessary, and then repeat. The daily moves in the market should not derail your plans. Please stay in touch as we close out the year, start a new one. There are a lot of great things on the horizon. We just need to find them, see where they fit into your plan. Have a great week.